Stop. Don't scroll. Don't check later. Don't let your brain whisper, it's fine. It bounced. Because when silver gets smashed and then snaps back to 78 like it got yanked by a chain, that is not acute rebound. That is a message. And the problem is, most people read that message exactly backwards. They see the snapback and they feel relief. They feel safe again. They feel validated. They feel like the market forgave them. But the market doesn't forgive. The market trains you. It trains you to chase strength when you should be patient. It trains you to sell weakness when you should be calm. It trains you to confuse motion with meaning. So today, I'm not here to hype you. I'm not here to narrate candles like it's a bedtime story. I'm here to hand you something that actually pays, a blueprint. A blueprint for what a snapback to 78 really means mechanically. A blueprint for who is in control when rebounds happen this fast. A blueprint for how to stop being the liquidity and start being the operator. Because if you don't get this right, you won't just lose money. You'll lose the thing that matters more, conviction. And once silver steals your conviction, it steals your future decisions too. Let's talk about what you think just happened. Most people think silver dumped, then it bounced, so we're fine. That's toddler logic. Markets don't move like moral lessons. Markets move like machines. And a violent drop followed by a violent snapback is usually not random volatility. It's usually one of a few specific mechanisms doing their job right on schedule. 1. A liquidity harvest. 2. A dealer hedging event. 3. A forced flow shock from positioning and mandates. And here's the part that stings. The snapback itself is not the signal. The snapback is the stage. The signal is what the market does with the snapback and who is forced to participate. So let me show you the market's favorite magic trick. Picture a stage magician. The magician doesn't fool you with the hand you watch. He fools you with the hand you don't watch. Silver's favorite trick works because humans are predictable. First, the vertical temptation. Price runs hard, headlines show up, the crowd gets loud, your brain starts confusing speed with safety, and you begin to say the most expensive sentence in investing. This time is different. Second, the slam. Right when the crowd is most emotional, price gets slammed. Not gently, violently, because gentle drops don't do the job. Gentle drops don't trigger forced selling. Violent drops trigger stop losses. Violent drops trigger margin calls. Violent drops trigger that exact moment where your hands shake and you think, I can't take this. And third, the snapback, not to save you, to humiliate you, to reset you, to rewire you. Because the machine wants two things. It wants weak hands to sell into fear. And then it wants those same weak hands to chase back and higher so it can take their money twice. So if you only learn one idea from this entire video, learn this. A snapback is often not a rescue. It's a reset. And resets exist to set up the next trap. Now here's the real question you should be asking. Who is buying? Because there are two kinds of buying in markets, and only one of them you can trust. There is forced buying, and there is chosen buying. Forced buying is mechanical, unemotional, necessary. It's short covering when the move threatens survival. It's dealers hedging options exposure when gamma flips and their book demands it. It's funds rebalancing because their mandate says they must. It's risk models re-adding exposure because volatility changed their math. It's positioning unwinds that have nothing to do with belief and everything to do with I have to. Forced buying can be powerful. It can launch price like a rocket, but it is not loyalty. It can vanish in minutes because it was never love, it was obligation. Chosen buying is different. Chosen buying is conviction money. It's patient. It's strategic. It's not in a hurry because it's not scared. It's long-term accumulation on weakness. It's physical demand stepping in when paper is throwing a tantrum. It's investors who already planned the dip before the dip arrived. It's the kind of buying that holds levels instead of just tagging them. So when silver snaps back to 78, you don't clap. You don't celebrate. You don't declare victory. You diagnose. You ask, is 78 being defended or just revisited? Because there's a huge difference between price traded there and price is being protected there. And now I'm going to give you a method so simple you can use it under stress. You don't need 20 indicators. You need 3 lines. 3 lines that control your outcomes. The first line is the panic low. The panic low is the lowest point of the flush. It's the moment people hit sell because they couldn't breathe. It's the level where the most emotional exits happened. That is a reference point. Not because it's magical, but because humans are consistent. If price revisits that panic low and breaks it cleanly, the market is saying fear is not finished. The liquidation isn't done. There's more to harvest. If price revisits that panic low and rejects it violently, the market is saying we tested supply and it wasn't there. The selling was exhausted. The second line is the breakdown ledge. This is the level that broke right before the flush accelerated. It's the floor that became a trapdoor. A snapback that cannot reclaim the breakdown ledge is often a bull trap with good lighting. A snapback that reclaims the breakdown ledge, holds it, and turns it into a floor is something else. It's structure. It's the beginning of control returning. And the third line is the liquidity ceiling. This is the obvious zone everyone is staring at, the round number area, the prior swing high, the place where stops and breakout buys cluster like moths around a flame. That's where the market loves to stage the next ambush. So watch this carefully. If silver snaps to 78 and immediately stalls at the liquidity ceiling, that is not strength. That is the market finding victims. If silver snaps to 78, consolidates, and refuses to give it back, now you're looking at defense. Now you're looking at chosen buying stepping in behind the scenes, not just forced buying spiking and disappearing. This is why it hits 78 means nothing by itself. The story is what happens after 78 arrives. Now let's make this practical, because you are not a chart. You're a human with a position, and what this move means depends entirely on what type of silver person you are. There are 5 main types of people watching this right now. The first person, you bought the top. You chased a green candle. You hit market buy because you felt late. You felt that chest-tightening urgency that makes you do dumb things quickly. Then the flush hit and your stomach dropped. Here's the truth. You didn't get unlucky. You got targeted. That's what vertical moves are designed to do. They lure impatient money. They lure ego. They lure desperation. So what does 78 mean for you? It means you are standing at a fork in the road. You either keep playing the same psychological loop or you graduate. And graduation starts with one decision. Are you an investor or a trader? If you're an investor, stop behaving like a day trader. Stop staring at 1-hour candles and treating every wiggle like a referendum on your soul. Build a scaling plan. Decide how much you want long-term, then buy like a machine. Scheduled, calm, disciplined. If you're a trader, then trade like one. Define your invalidation level. Decide where you are wrong. Respect that line like law. Don't hope your way out of trades. Hope is not a strategy. Hope is how the market keeps you as a recurring customer. And most importantly, do not use the snapback as emotional validation for your original impulse. That is how a mistake becomes a personality. Second person, you sold the low. You couldn't take it. You hit sell into the flush. You felt relief for 3 minutes. Then price snapped back and now you feel stupid. You feel humiliated. You feel like the market played you. Listen, the market is not trying to make you poor. It's trying to make you reactive. It's trying to turn you into a lever it can pull. Selling the low is not a moral failure. It's a system outcome. The market is designed to apply pain at the exact moment your nervous system is least capable of rational thought. So what does 78 mean for you? It means the market just showed you your weakness. Good, because you can fix a weakness once you can name it. Your fix is simple but not easy. You must separate your world into 2 buckets. A core position bucket that you do not touch emotionally. Thesis-based, long-term, boring, and a tactical bucket that is rules-based, quick exits, controlled risk. Most people blow up because they mix these two. They panic sell the core and then chase back in with the tactical bucket. They turn long-term into short-term at the worst time, and they wonder why they always feel late. Don't mix buckets. That's how you stop bleeding. Third person, you held through the flush. You watched the red and didn't flinch. You didn't blink. You did nothing. If that's you, the snapback to 78 is not a reason to brag. It's evidence that your temperament is an edge. In silver, temperament is alpha, because the metal doesn't just test your analysis, it tests your nervous system. Now your job is not to get arrogant. The market loves to reward discipline and then punish pride. So what do you do now? You pre-plan the next trap zone above 78. You decide in advance. Where would I add? Where would I take partials? Where would I do absolutely nothing? Write it down before price gets emotional again, because in the moment, you will lie to yourself. Everyone does. The point of writing it down is not because you're weak, it's because you're human. Fourth person, you are a physical stacker. You don't care about intraday noise. You care about the end game, purchasing power, insurance, repricing, and the difference between paper and reality. For you, the snapback to 78 is a reminder of something that will make some people uncomfortable. Paper volatility is not your enemy. Paper volatility is your discount schedule, but only if you behave like a stacker. Not like a chart addict. Your advantage is time, so use it. Buy when the tape feels disgusting, not when it feels heroic. Build a simple rule. When price is vertical, pause. When price is hated, step in. When the crowd is euphoric, protect your future self from your current excitement. And track more than spot. Track premiums, track availability, track delivery delays, track whether local shops are tight, because spot is paper's opinion. Availability is reality's vote. Fifth person. You're trying to trade this move right now. Okay, then we get surgical. Your entire job is to not be the liquidity. No market orders in emotional moments. No stops placed where everyone places them. No entries at obvious levels without structure. You trade structure, not excitement. And structure comes from scenarios, not feelings. So here are the 3 scenarios that matter after a snapback like this, and I want you to memorize them. Scenario 1, the V recovery. Flush low holds, price reclaims the breakdown ledge, it builds higher lows, it grinds upward, not in a straight line, but with controlled pullbacks that do not collapse. What does that mean? It means the weak hands were cleared out. Forced selling is mostly done. Buyers are defending. How do you trade it? You don't chase the first spike. You wait for the first higher low. You enter on the retest with defined invalidation below that higher low. You scale, you don't swing for the fences. What kills you? Buying the top of the spike, feeling like you'll miss it. That desperate, I have to be in energy. That is literally what the market is selling. Scenario 2, the dead cat trap. Price snaps back, tags the breakdown ledge, stalls, then rolls over and revisits the panic low. What does that mean? It means the bounce was mostly forced. The pressure relief happened. And now the market wants to punish the people who felt relief and bought it. How do you trade it? You treat the breakdown ledge as a decision line. You take quick trades only if structure holds, and you are willing to exit fast if price fails the reclaim. No ego, no speeches, no it should. What kills you? Believing the snapback proves the bottom is in, averaging down without a plan, using hope as a hedge. Scenario 3, the range prison. Price snaps back, then chops sideways with violent up candles and violent down candles. No trend, just a blender. What does that mean? It means inventory is being built. Big players are accumulating or redistributing. Retail is being bled through overtrading. How do you trade it? You reduce size, you trade less, you only take the extremes with tight rules, or you step aside until the range breaks with confirmation. What kills you? Trying to force a trend, taking too many trades, confusing activity with progress. Now, if you want the highest value part of this entire video, it's not the scenarios, it's the checklist. Because a snapback like this is a fork in the road. You will either convert volatility into advantage, or you will donate to the machine again. Here's how you convert it. First rule, stop worshiping the number. 78 is not holy. It is a location. Ask, is it being defended or used? Second rule, define your time frame before your entry. If you cannot answer, am I holding this for days, weeks, or months? You are gambling, and gambling feels exciting until it feels expensive. Time frame determines position size, risk tolerance, stop placement, and what success even means. Third rule, separate core from tactical. Core is long-term, boring, resilient. Tactical is opportunistic, rules-based, quick exits. The reason people lose isn't because they lack intelligence. It's because they lack separation. Fourth rule, use volatility to scale, not to panic. Scaling is what professionals do. Panic is what donors do. Write your scaling levels before price gets emotional again. Fifth rule, if you cannot explain why the move happened, you are not allowed to trade it. Read that again. If you cannot say calmly, this snapback is likely short covering, or dealer hedging, or flow shock, then you don't have a reason. You have a feeling. Feelings are expensive in silver. Now let's go deeper, because most videos never give you the plumbing. They give you a story. I'm giving you the mechanics. Here's the hard truth. The silver market is not primarily a calm price discovery mechanism. It is a position management mechanism, a place where leveraged players manage exposure, where hedgers adjust risk, where dealers hedge options, where funds rebalance mandates, where retail provides liquidity at the worst times. That's not a conspiracy, that's leverage. So why do snapbacks happen so fast? Mechanism 1, stop cascades and air pockets. When stops trigger, bids vanish, price falls into emptiness. The market didn't decide silver is worthless. Liquidity just disappeared. Then, when selling pressure exhausts, price rebounds because the air pocket is gone. It's like stepping off a curb you didn't see. You don't fall because gravity got stronger. You fall because the ground wasn't there. Mechanism 2, short covering, is buying with panic. Shorts don't cover politely during a snapback. They cover because the move threatens their survival. That's why rebounds can be vertical, not because everyone is bullish, because someone is trapped. Mechanism 3. Options dealers hedge when certain strikes and exposures get threatened. When price moves quickly through key zones, dealers can be forced to buy or sell futures to stay neutral. This is one reason silver can look like it has a mind of its own during violent moves. It doesn't. It has a book. Mechanism 4. Fund flows don't care about your feelings. Index rebalances, systematic models, cross-asset vol targets, risk parity. These flows can force buying or selling regardless of what you think should happen. So, if you're sitting there trying to assign moral meaning to every candle, stop. This is physics, not poetry. And once you treat it like physics, you stop taking it personally. Now, here's where the value becomes unfair, because I'm going to give you a way to confirm whether the snapback is likely forced or chosen without needing insider access. You watch how price behaves when the excitement fades. Anyone can spike. The real test is quiet minutes. Does price bleed down quietly, hour after hour, like a balloon leaking air? That often suggests the snapback was mostly forced, and once the forced buying ends, gravity returns. Or does price hold firm, refusing to give back ground even when headlines go silent and the crowd stops yelling? That's what defense looks like. Then you watch the shape of the movement. Does it look like spears? Sudden spikes up, then immediate give back. That often screams forced buying and thin liquidity. Or does it look like stair steps, higher lows, controlled pullbacks, consistent bids? That's what chosen buying builds. Then you watch whether price teleports through zones or works through them. Teleportation often means stops, thin liquidity, forced action. Working through zones means structure is being built. Structure is what you can trade. Teleportation is what trades you. Now we turn this into a battle plan, because without a plan, your brain becomes the market's favorite toy. Step 1, identify your role today. Say it out loud. I'm a long-term investor adding to core. Or I'm a swing trader aiming for a multi-day move. Or I'm a day trader only. Or I'm a physical stacker ignoring noise. If you don't pick, the market will pick for you. And the market's choice is always the one that bleeds you. Step 2, draw your decision lines. Panic low, breakdown ledge, liquidity ceiling, 3 lines. Everything else is decoration. Step 3, write your if-then rules before you click. If price reclaims the breakdown ledge and holds through retests, then I scale in. If price tags the breakdown ledge and fails, then I do nothing, or I hedge. If price breaks the panic low cleanly, then I pause buying and wait for stabilization. If price holds above 78 during quiet minutes, then I treat it as defense, not a fluke. The entire goal is to remove improvisation. Improvisation is where emotions sneak in. Step 4, size like a professional. If you size like you must be right, the market will eventually show you that you're not. Professionals size like they can be wrong and live to fight again. Step 5, stop trading your self-respect. This is the hidden killer in silver. People don't overtrade because they love money. They overtrade because they hate feeling wrong. A snapback is designed to trigger revenge behavior. Now I have to make it back. Now I have to be right. Now I have to catch it. No. You don't have to catch anything. You have to execute. Now I'm going to say the uncomfortable truth about what this snapback to 78 means for you, stripped of comfort. It means this market is currently being driven by leverage and positioning more than calm discovery. And that means entries matter more than ever. It means patience is a weapon. It means emotional control is literal profit. It also means something else that should make you pay attention. When the market behaves like this, the eventual repricing, when it becomes one-directional, often punishes anyone who got chopped out early. So yes, you want to be positioned, but you want to be positioned like a sniper, not like a gambler. Snipers wait, gamblers chase, and silver is a machine that feeds on chasers. Now here's your next day and next week playbook. If you're long-term, pick 2 ad zones, 1 moderate pullback zone and 1 deeper pullback zone. Commit to scaling, not all in. Stop checking price every 10 minutes because you are not paid for anxiety. If you're a swing trader, wait for structure. You want that higher low above the breakdown ledge, not the first dopamine spike. Enter on the retest. Keep invalidation clean. If it fails, you exit. You don't argue. If you're a day trader, reduce size. Avoid the first emotional burst after a major spike. Don't fight chop. Trade extremes with rules or stand down. Standing down is a position. If you're underwater from a FOMO entry, decide whether you're converting to core or cutting as a trade. Do not sit in limbo. Limbo is where your brain bleeds you slowly. And now the closing message, because I want you to remember this the next time silver tries to hypnotize you. The snapback to 78 is not here to make you happy. It's here to test what you are, a reactor or a planner, a chaser or a builder, a donor or an operator. If you treat this like entertainment, you'll trade emotions. If you treat this like a machine, you'll trade structure. And the people who learn to trade structure in silver are the same people who are still standing when the real repricing finally arrives, because when that day comes, it won't feel like a normal rally. It will feel like the market stopped asking for permission. And if you've spent months training your nervous system to panic at every flush and chase every snapback, you won't be able to hold through the move that changes everything. So here's your job after today. Stop being impressed by speed. Start being loyal to process. Define your lines. Define your time frame, define your rules, and the next time silver tries to harvest your emotion, you'll be the one doing the harvesting. If you want the perfect follow-up episode that pairs with this, it's this. The next trap, after 78, the level where silver steals your confidence again. Because yes, there is usually a next trap, and next time you're going to be ready.